Hello, everybody. Thank you very much for joining us on this wet Tuesday evening. If you have children and you're sending them overseas to university, you'll know just how painful it is to get them accommodation in the city of their choice. Do any of you have children that you've sent overseas? Or maybe you did 15 or 20 years ago? Well, let me tell you, the level of accommodation in Europe for students, as well as other parts of the world, Asia and the US, is in such high demand that in some cities they're even balloting for it. And the irony is that it's actually for a very short time. How long do your kids study? How long do your kids study? 3 years? 4 years? Hopefully not longer than that, right? And so ultimately you're in this fight with parents from all over the world who are sending their children to the same colleges internationally, and you're all fighting for the same apartments, and 3 years later it's all over. And yet that's obviously where the business opportunity arises. At least one of the business opportunities of our special feature this evening, and in a few moments we'll hear from Centurion Corp and the senior leadership team that's going to be presenting here on stage and taking your questions. We plan to wrap promptly at 8 p.m. So if you do have questions, some of them were pre-submitted. I promise we'll try to get through as many of those as we can. Others, if you do have, please raise your hand at some stage during the evening and we will get the microphone to you. We can't make university recommendations, but we can certainly help you in terms of figuring out what the dynamics of the student and also worker dormitory environment is. My name is Mark Lowdy. My first guest here on the stage this evening is the market strategist at SGX. Please put your hands together for Mr. Jeff Howie, who incidentally also does not have children at university.
We'll soon.
At least not yet.
We'll soon, but it's interesting because I'm quite active in the alumni associations across Singapore. I went to University of Queensland, but our RMIT is clearly the most popular university for Singaporeans, and I think that's pretty much very close to the old Melbourne Hotel, which is student accommodation facilities. But I'm not here to talk about Centurion. I should hurry up and finish off soon. There's a clock at the back there above the camera, and that was actually put in for me to make sure I do finish off on time a few years ago. But it's really nice to be with everybody here from the SIAS client base because we've worked obviously together a lot over COVID during the webinars, and as per usual, I just want to give a very quick educational overview on the here and now in the Singapore stock market. So for the first half of this year, our returns were relatively muted when you compare it to 2022 when we were actually the best performing benchmark across APAC. This time around, we were more in the middle of the ladder. The total return of the STI, the Straits Times Index, was 1.2% in the first half of this year. And that was pretty much in line with our most correlated bigger regional index, the FTSE ASEAN Index, for the first half. Now, what that means is it brings the returns of the Straits Times Index since the end of 2019, pre-COVID, to the end of June to 14.5%, which is basically doubled the total return of the FTSE Asia Pacific Index. One key reason for this has been the strength of the Singapore dollar. The MAS actually moving ahead with tightening back in October 2021 when they first started, completing the tightening cycle in October 2022, keeping ahead of the curve, and meaning that since the end of 2019 through to the end of June, you basically had your Singapore dollar appreciating in line with the US dollar. But that also meant that the Singapore dollar appreciated around 13% to the Malaysian ringgit. It appreciated 8% to the Indonesian rupiah. It appreciated 5% to the Australian dollar, and it appreciated 4% to the renminbi. So this meant that we had competitive returns, but it's also created maybe a little bit more drag for our exports and industrial production. When you look at our stock market, it is very geographically diverse. The Straits Times Index is comprised of 30 stocks. The most recent stock to join the Straits Times Index in June was Centurion, with Keppel DC REIT coming out. That means that Singapore revenues account for 50% of the revenue exposure of the STI in its weighted form. It means that half the revenue associated with the index is actually generated from outside of Singapore, but mostly across Asia Pacific, very much paralleling our trade partners in terms of having revenues in China, Indonesia, Malaysia, and Hong Kong. So that geographical diversity really does extend outside the STI a lot. If you look at the number of companies that we have that report more than half their revenue to our Southeast Asian neighbours, that's as many as 90 stocks. If you look at stocks that report more than half their revenue to China, that makes up around 80 stocks. And if you look at the number of stocks that report 90% plus of their revenue to Singapore, that narrows our universe of stocks down to only 140 stocks. So there's a lot of Singaporean companies that have grown and built their revenues in overseas countries or based their assets overseas as well. And there's also a number of international companies that have come here to list in Singapore as part of their capital raising and expansions into Southeast Asia. So it is really highly international. And for that reason, we very much do have the world's most diverse stock market. If you look at it too from a trade angle, it does make sense, because if Singapore, okay, let's say if the G20 was built on countries that have, are the top 20 trade nations by trade value and not GDP, Singapore would be in the G20, because we are the world's 6th largest exporter, 16th largest exporter and 16th largest importer. So it means non-oil domestic exports and industrial production are super important to our performance in Singapore. And this is where we're having these difficulties right now, because non-oil domestic exports have been in contraction since October last year. They've also been in contraction for South Korea since October last year, and they've been in contraction in Taiwan since September last year. At the same time, industrial production in Singapore has been in contraction since October last year. Now, of Singapore's industrial production, it spans 6 different clusters, the biggest of which is electronics, which makes up 45% of Singapore's industrial production, and 38 percentage points of that 45% of electronics is actually semiconductors. So much hinges on global electronics demand. So manufacturing in Singapore is already in recession. On Friday at 8:30 or 8 o'clock in the morning, we're going to have our advanced GDP for the second quarter released for Singapore, and that's expected to show a 0.2% quarter-on-quarter contraction, which also puts Singapore in technical recession as well, because in the first quarter, we printed 0.4% quarter-on-quarter contraction, albeit a 0.4% year-on-year gain. So the outlook for Singapore growth is to be around 1.4%, maybe tops for this year, but then to accelerate next year to around 2.6%. And this is very much like the electronic cycle as well. So inventories are being written off and not expected to get to be normalized until early next year, as well as global electronics demand as well. What's made this year different is that the recovery in China has not been investment-led. It means that because it's a services-led recovery, you don't have that economic spillover to Asian nations. So if you have a services-led economy in China, then your impact on exports across all the trade partners of China is negligible. But if it was construction, manufacturing-led, you have these positive spillover impacts that just aren't going to happen. So very different. What's happening, though, is that there are still bright spots. People have talked about revenge travel, but I think it's much more than that. I think travel, tourism, ability to go to Taylor Swift concerts. Anyone? Yeah, I'm not going. I do the Money FM, and on Friday, the lady was asking me if I was going to Taylor Swift concert, and on the live, I said, I have no idea when it is. Do you know? And she didn't know, and they actually edited out of the podcast because it just showed that none of us had any interest whatsoever. But people are, and this is what's changed. The price on tourism and entertainment has been repriced upwards. So this might be a bigger part of the Singapore economy, because as strong as construction is, as strong as retail is, as strong as real estate is and F&B is in Singapore, it's a pretty small part, less than 10% in total of Singapore's GDP. Much of it has to do with services, particularly financial services. In the Singapore stock market, the STI, much of its performance hinges on the banks. Because our three banks have averaged 33% total return since the end of 2019 versus 10% for the regional banks, 5% for the global banks, has been a key reason for this outperformance of the STI. The three banks themselves, anyone want to have a guess how much they paid in dividends for FY22? In dollars, yeah, Sing dollars. 10 billion. 10 billion Singapore dollars to all their shareholders is what the banks paid last year, which was significant. And then they've backed that up with very high ROE. So DBS has a record high ROE of 18.6% at the moment. I think that's come down a little bit now, and it will be reporting 4th of August or 5th of August. I think it's 4th of August. So the banks will report between 27th of July and the 5th of August. The ROEs are around 15% for UOB as well as OCBC. Now, reason being is they have been interest rate hedges for a lot of investors, but a lot of that's been priced in very, not a long time ago, but very much before the fact. So 66% of the revenue of the banks comes from net interest income, which is basically built on the size of their loan books, and they still expect to grow their loan books by 3 to 5% this year. That's why it was important for DBS to write that loan to the MAS to help it grow their loan book as well. At the same time, it's driven by net interest margins, which is basically your interest rates differentials, which has seen their net interest income at around 8 billion Singapore dollars on a combined basis every quarter. That's where it is now. It was around 5.4 billion a year ago, but because of the increase in interest rates, it's around 8 billion now. And the problem is the inflation in the US is super persistent. There's a lot of proverbials that are used, and they're polite ones, but the Fed, I think their thinking is that they are quite concerned that the key gauge, the PCE core deflator, really they look at the sub-aggregate, which takes out housing, but it's been so range bound. So since the end of November 2021, right through to May, you have this core services-led inflation in the US range bound between 4.4% and 5.4%. In May, it was 4.6%. So it's very much range bound and not showing signs of really coming down like the headline CPI numbers. So for that reason, we're thinking inflation is going to be higher for longer. There's 4 Fed meetings before the end of Christmas, and there's now as much as 30% expectations that the US interest rates will be 5.5 to 5 3/4 at the end of the year. So this is a key thing for the banks. It also means that because of the decelerating growth outlook that these higher interest rates have, banks have also got to make sure they keep their NPL ratios at good levels, which are at, I think, 1.6% for UOB and 1.1% for OCBC and DBS. And very importantly too, just to end off, 1 minute, what the banks have seen, as well as the REITs, is net retail inflows this year. Basically, for the first half of this year, retail investors saw net buying of 1.49 billion Singapore dollars, which was up from 951 million for the first 6 months of last year. But it's not so much more buying, it's less conviction at the moment. A little bit of a market uncertainty, obviously. So we saw overall stocks that saw net buying by retail investors saw a less amount in net buying. Stocks that saw net selling by investors saw a lesser amount than they did this time last year. So that little bit of uncertainty does make sense, because you have 400 stocks that are about to report their first half semi-annual financial numbers. And at the moment, when you look at the most recent MAS professional forecaster survey results, it was about 2/3 of the economists thought that corporate earnings in the second quarter of this year will be lower year on year. I think there are about 20%, 22% that actually thought they will be stable. So expectations are pretty low, and we'll see what happens from there. But that's my wrap. Very quick 15 minutes, just what's going on in terms of our Straits Times Index. And what I'll do is bring over to Mark. As I said, STI is up 1.2% in the first half of this year, and the company that's going to talk next, its share price has moved from 33 cents to 39.5 cents over the same period, so that's close to 20%.
Thank you very much, Jeff Howie. Thank you. Let's go. Yeah, Taylor Swift. I got this suit made very fast. Our first speaker today, and who will also be here to take your questions, has been with Centurion since 1996. Cast your mind back how long ago that was, which just goes to show the track record that he and the senior leadership team bring to the organization. Centurion Corp, please put your hands together for the Chief Executive, Mr. Kong Chi Min. There you go.
Thank you very much. Thank you, Mark, for the introduction. A very good evening to every one of you. I noted that you have just finished your dinner, so I hope that you can stay awake. And I'm trying to do this presentation as exciting as possible. I'm not as eloquent as them, but I'll try. Okay. So thank you for joining us today. So today we will be talking about our company tapping global growth in a specialized accommodation, right? By the way, my name is Chi Min. I'm the CEO of Centurion Corporation Limited. 27 years, correct? But as a CEO, starting from 2011, right, where the company repositioned itself to do workers' accommodation then. Okay, I will share with you a bit more later. Now, I think quickly. Oops, sorry. Okay, my presentation will cover in 4 sections. One of them, or the first one, is actually just to give you a corporate overview. Second thing, we will go a bit deeper into the portfolio that we have and also the business outlook for the next year, and also then the what's next, right? Going ahead. Then the fourth is Q&A, which we will be on the panel for any questions asked by you, right? Now, before even I go into the corporate overview, I noted that most of you are retail investors, so I think retail investors will be very keen in terms of knowing what is value, is there value in investing in Centurion, right? And what is that? So I'll just come on the first slide in showcasing in terms of our performance thus far in terms of earnings per share as at 31st December 2022. Our earnings per share is 8.5 cents, which is a growth from the previous year, which is 6.27 cents. For NAV, right, which is a book per share, is actually 81.7 cents, right? Dividend, we have given a dividend of 1 cent per share last year, right? That is a growth of from half a cent to 1 cent in 2022. Now, share price, as what Mark and Jeff have said, right? Share price as at 31st December 2022 is 33.5 cents, and now is 39.5 cents. That is a growth of 18%, right? Close to 18% right now. So with this increase in share price, does it mean that, is there any value or any, I would say, upside to this share price? So to answer that question, we have to look at what is the PE ratio, right? At the moment, the PE ratio, if you look at the PE ratio based on the price of 39.5 cents, it's actually at 4.65 times, right? For investors, you do know that this is a pretty low PE ratio. And also in terms of the price to book, is only at lesser than 50%, which means that it is heavily discounted. So why is it this? So looking at the ratios, it seems that the shares is pretty cheap, right? I guess you all know that, right? So where's the catch there? Is there something that we don't know? There must be a reason why in the first place is so cheap, right? Okay. Of course, for this, the objective of me coming here is also to do investors engagement. I hope that I will be able to share some light to why, yes, it's cheap, but is there value to this? Whether is there such things as good and cheap, or cheap and yet good, right? So I hope that you, in the following slides, I'm able to excite you and demonstrate to you that that is really value good for money, right? Okay, for Centurion is actually in a business, a very established business with strong fundamentals in operating in several growing markets, right? The model is very simple. We only have two core business. One of them is actually purpose-built workers accommodation. The other one is actually student accommodation. For workers accommodation, we are the largest provider in Singapore. When we are talking about workers accommodation, we are talking really about migrant workers accommodation, that means foreign workers dormitories, right, in Singapore and also in Malaysia. We are operating in 7 operating assets within these 2 countries. And for student accommodation, we are in various global educational hubs, for example, Australia, UK, and also in the US. We are also in South Korea, right? South Korea is not really a major educational hub. But we have one single asset in there, but we have actually sold it off. Later I'll explain. So, but what it is that on this student accommodation, it is backed by there is unmet demand in terms of purpose-built student accommodation, which is why it leads to a lot of I would say good rental reversions and also good yields. That we are going into the student accommodation is comparable to workers accommodation. We as a company, we not only just manage and operate, we actually do development as well. So we develop, own, manage. That is our model. And we manage under the 2 established and professional brands internally created, Westlight for workers and Dwell for students. Okay. And through the years that we are managing these 2 core business, it has able to generate and demonstrated that it generated quality earnings and also steady cash flow. And with our lead, we also have a very stable, experienced leadership over average of 20 years in the industry. Just a bit on the corporate performance throughout the year in terms of how we have grown. Started in 1984. The company does optical disc media business. In 2011, we reinvent ourselves and move away from totally from media manufacturing to do a new business in accommodation, in workers accommodation. At the start, we only have 5,300 beds, and since 2011 to now, we have grown to close to 67,000 beds. But there are certain milestones that I want to let you know in terms of how we actually grow. In 2011, we only have 1 asset in Singapore, 5,300 beds. In 2022, we then venture into Malaysia, right? We buy land and we expand in Malaysia, in Johor. In 2014, we have evaluated the market. We take 2 years for us to evaluate the student market. And in 2014, we go into student accommodation by acquiring student hostel in Melbourne. And then in the same year, we went to UK and acquired another 4 student accommodation assets in Manchester and Liverpool. That started our journey in student accommodation. And then in 2017, we go into US. that is also a milestone that we did. We actually established a private equity fund or private real estate fund in acquiring 6 assets in US, and that started our asset light strategy in terms of bulking up our portfolio. Okay, and a point to note also that during 2020 and 2021, that is also the pandemic years, we have also expanded our portfolio during that particular period. So very quickly, in terms of the accommodation portfolio growth, 2011, that is 5,300 beds. As you can see that now currently we are close to about 67,000 beds. The yellow ones are the workers' accommodation. The blue ones are the student accommodation. That's how we grow. And if you look at 2018, there's a slight dip. Why? Because there is a lease in a workers' accommodation that has expired and we have returned back to the government. But that dip was quickly covered back by further expansion into workers' accommodation and also student accommodation. In 2022, you see that while the bed count dropped again, right? This drop of bed count is because of Malaysia. Malaysia, they implement, or rather they implement this Act 446 in Malaysia. We need to refurbish our assets, and by refurbishing our assets, we also reduce the number of beds in there. But this reduction of beds has not actually affect our revenue, because in our business model, we actually lease the assets, or rather we lease the beds in the form of a unit. So one unit, for example, there are 12. We charge based on per unit basis. Even though 2 beds are being reduced, we charge the same rate. So effectively, there's no reduction in terms of our revenue. Okay. Along with the growth in portfolio, you can see that while our accommodation revenue has been increasing year on year, except for 2018, as what I explained why. And then also in 2020 in revenue, you realize that indeed there was a dip due to the pandemic, right? Occupancies are indeed affected during that year, but very quickly in 2021, you see a revenue growth. That's the reason being is that during the pandemic years, we have also taken or snatching opportunity by investing into assets that actually came out because of the pandemic. So we have invested in some assets like in QBD, right? That the government actually released. Plus also the fact that we have also bid for some management contracts in operating MWCs during then. MWCs are an onboard center where the government in Singapore actually established to quickly bring in back the migrant workers, which is needed to finish off all the projects in Singapore. So, and you can see that the net profits has actually grown accordingly, right, over the years. And of course, 2022 is a recovery story, and you can see that there was a jump in terms of impact and also revenue. Today, okay, we have about 66,000 operational beds over 17 cities in 6 countries. 36 operating assets, and we are managing 1.9 billion of asset under management. As mentioned, these are all the countries that we are operating in. South Korea, we have divested that single asset purely because that this is only a single asset. We knew that we don't have any potential of further expansion due to the capital value or the investment value in South Korea. So we rather exit from that market and focus on those markets that we are able to expand. So very quickly into the purpose-built workers' accommodation front. Okay, so why is it workers' accommodation is that highly sought after? Now the reason is because there are 2 reasons, right? One of them is regulatory, the other one is really demand and supply factors. So the high demand is because that many countries nowadays rely not only their local workforce to support this economy. Many countries now rely on migrant workers or other less developed countries for manpower. Like Singapore rely on migrant workers to build their homes and all that. But many other cities, even including recently Hong Kong has announced that say that wow, they are also going into this in terms of bringing migrant workers to help. them. I mean, Australia, similarly, what they call it, Japan, similarly as well. So not only Southeast Asia and Middle East countries, we see that there's a growth in terms of bringing migrant workers to help the economy, but they need to stay somewhere, right? And therefore, that means that there's a need of accommodation, and therefore, the growth in terms of this sector becomes the demand or the growth of this accommodation is quite clear, right? But again, there are also growing awareness of the welfare of foreign workers and migrant workers as well, right? And this can be seen by government putting in more regulatory legislation to require employers to provide quality accommodation. Like, for example, in Singapore, there's this Feeder Act in Singapore, and in Malaysia is Act 446. And there is also international ethical pressures from organizations such as International Labour Organization, but they also specify the required specification on workers' dormitories, how they are being built, how much space are being allocated to which worker, each worker. Same thing also for Responsible Business Alliance. I'm sure you have heard of Top Glove, right? Over the news that they are also in the limelight because of the fact that they did not provide good accommodation to the workers, and therefore they suffered in terms of sanction from Europe, right? In terms of their products, and they had to then shift the workers to quality accommodation. In fact, they have shifted their workers to our accommodation during the pandemic, right? And they are still one of our customers right now. And in order to also to lift up, I think we help them in terms of lifting up in terms of the sanctions too. So as you can see, the demand and supply dynamics driven by the demand factors are relatively strong, and also the quality of the accommodation that the industry requires has actually improved as well. So in this sector, we are, and as mentioned, we are the largest. Not only the largest, I think we are also a well-regarded brand over in providing not only just the design aspects of the purpose-built workers' accommodation, but also the management, the platform, the holistic management of the well-being of the residents through a comprehensive community programs and activities that were organized for them. So the pictures actually just show, I'm not going to go through the pictures because I only have 20 minutes, right? This is all the amenities that we provide. So it's like more like a condominium, right? Style that we are providing to our migrant workers. Now, in Singapore, we have 5 operating purpose-built dormitories. They are RC structure, concrete, I would say, 27,500 beds. And we have 4 QBDs, which is 6,400 beds. These QBDs are the ones that I talk about taking opportunity that it rises due to COVID-19. And we also operate 5 community recovery centers as well, but it's not in this chart because basically it's only under a management service contract with MOM. It's temporary, right? And depending on the situation of pandemic, this contract would not be renewed. So, okay, so we'll talk about in Malaysia as well. We have 8 operating assets, 26,000 beds, so we are relatively very big. We started in Johor, which is why you see that there are so many dots in Johor. Then we expand into West Bukit Minyak in the north, that is in Penang. And then during the pandemic years, we actually also acquire another dormitory long lease in PKNS Patalang Jaya in Selangor. Okay, so I would like to actually explain to you in terms of the landscape in Singapore. Pretty much, I think there are quite a lot of interest now from investors and also calls to say what is the changes in terms of the workers' accommodation landscape. If those who had or rather read the newspapers, in fact, the minister actually just only recently announced saying that the bid rents for workers' accommodation pre-COVID 280 has increased to 420. That is about 50% increase, right? That came out from the minister's mouth. Of course, this is a fact. We actually see that as well, and there is a reason for that. Post-pandemic, there is a very big demand. The migrant workers the migrant workers population has increased from 318,000 in 2011 to 415,000, and in this space for migrant workers is heavily regulated by the government, right? So only certain sectors they would require them to stay in purpose-built workers accommodation, or we call it accommodation that is being approved by them. And these are, we call it the CMP workers, which means stands for construction, marine, and process sector. So they cannot stay in the HDB. They cannot stay in any old house that they want to put their workers into. So if you're looking at purpose-built workers accommodation, which is the highly sought after one, there are only 207,000 beds. And we are operating in one, there are short-term PBWA and long-term PBWA. We are operating on the permanent PBWA, the long-term ones. Most of our dormitories are in, or I would say now all are in the long-term PBWA space, right? And space. So the non-purpose-built dormitories is where, because there is not enough demand, not enough supply, sorry. So the government has allowed even factory to convert 49% of their GFA, right, into dormitories, right? There are about 100,000 beds, but because of the government noticed that there's a shortage, now the figure may have grown, right? Then there are on-site dormitories in construction sites, about 20,000, and then another 26,000 in shop lots, and also some low-cost housing apartments that the government allowed them to stay in those locality. So clearly there's a major short, but we're looking at that, where is the new supply coming from? There are new supplies that the government has actually released over the last 2 years, like for example, the QBDs, 25,000 beds, and they also intend to increase the bed count in CTQs as well. We don't have some numbers here because the numbers now could have actually increased to meet the demand, but clearly from all this, there is a very big unmet demand here, which is why the rates has actually gone so high. The government has actually also announced that they want to increase the dormitory beds by another 100,000 to do some replacement, because those short-term purpose-built dormitories will have to fall off. But they have so far announced about 11,000 beds, and these 11,000 beds are really in development. There are about 10,000 that they have announced that is actually operated by NES. The government actually wanted to manage, they do a trial and they want to manage themselves. That's about 10,000. There's about 1,600 beds that we have tendered successfully, and that's all that new supply has come out in the market. So a bit of the performance and business outlook. The performance which we experienced in 2022, average financial occupancy of Singapore is 97%. It has actually improved tremendously from 2021, which is actually the COVID years. This increase, or rather this occupancy rates has further went north, and currently there's a long queue for our accommodation in Singapore. And thereafter, as you can see that, well, because of that, the bed rents has increased, right? So Malaysia is not like Singapore. The recovery is not as fast. In 2022, we have 80%. That is because that the government SOPs are not that ready in terms of bringing back the migrant workers. But now most of the migrant workers has came back. Our occupancies has obviously improved very much, and also because of the demand of this purpose-built workers accommodation in Malaysia has grown also because of Act 446. We have in our dormitory, I would say that we actually focus on manufacturing workers, because manufacturing companies do take care of the workers better compared to plantation, construction sector. So of the 3 states that we are operating in, accounts for 35% of the total foreign workers workforce, about 2 million. So as you can see that our size of 26,000 is only a fraction of the demand that will require quality workers accommodation in Malaysia. So the upside for Malaysian market to us is very great. This is a bit on in terms of concentration risk. We don't have a sector concentration risk or any customer concentration risk, because any customer, we don't have a customer who has more than 5% of our group's turnover. And for the sector, because of our assets are able to cater to various different sectors, not like certain accommodation whereby they can only take construction workers or certain sectors. Because of that, even though due to any economic fluctuations and all that, we will not be badly affected. And that has demonstrated during many times during the economic crisis. Okay, for purpose-built student accommodation, well, I think I don't need to explain too much about the student accommodation. This asset class is really highly sought after by institution investors for a reason. I believe you know that Mapletree has invested heavily in student accommodation, Escort, CapitaLand. In fact, GIC is into this as well. Why? Because the supply of purpose-built beds in most, I would say all education hubs are very short. If you look at the chart, those dark color ones are the ones that is the unmet demand. Currently, they are staying in private residential homes, or we call it HMOs, but they are not really very, the quality is not very great. So students, because of safety, or because of also the fact that having to make friends in the accommodation, that so students would love to stay in purpose-built workers student accommodation, which is where we see the demand is. So, well, we are not very big in the student space. I mean, the student space is very, very big. This market is very, very big. However, we are, our brands are out there. We are a pretty much well-regarded brand in those cities that we're operating in. We have comprehensive amenities and facilities, right? And also we have, more importantly, very comprehensive programs being customized for the residents that stay with us. So we do have a resident live team having to manage these activities on a day-to-day basis. So for the student accommodation portfolio, we have 10 operating assets in UK, 2,807 beds, right? Operating in 5 major cities. We are pretty much very big in Manchester. We have 5 assets in Manchester, 1 in Liverpool, 2 in Nottingham, 1 in Newcastle, and 1 in Bristol. So all these cities are, we call it Russell's University cities, right? They are renowned universities, and therefore the demand has, or rather, it has been very strong, and potentially going forward, I mean, the growth in terms of student population will be there, which is why we chosen those cities. Now, for Australia, we have 2 accommodation assets. One of them is Melbourne, and the other one is Adelaide. Similarly, I mean, these are where international students would love to go. In the US, we have 6 operating assets, 2,145 beds. These are the ones that we operate, or rather, we hold it under a private real estate fund, and we earn management fees from these assets. So for United Kingdom, in terms of the performance, has been quite great in FY 2022. Why is it only 90%? The recovery has been good. Why is it only 90%? Because we have taken some bits off our capacity, and we are doing a renovation and retrofitting to upgrade and enhance those assets. As you know, that for student accommodation, they are going by academic year. There's only a short time frame during summertime to do refurbishments, which is not sufficient for us to do A&A works. So we have taken off some, which is why it's 90%. But UK has recovered pretty well compared to Australia, for that matter. Australia, because of the borders have reopened later. Therefore, in FY 2022, we only achieved 73%. But in 2023, we would expect that the occupancy or financial occupancy to grow significantly. So all in all, for this asset class, we are seeing a shortage of this supply. The demand on the booking rates are pretty healthy and pretty good. Okay, for in 2023. Now, United States, the average occupancy, because it's actually a private real estate fund, we are not at liberty to share with you what is actually the financial occupancy, but it has been healthy and relatively stable. Our US assets are not, unlike Australia and UK, they are more towards targeting the domestic students. So during the COVID years, they are hardly affected in terms of financial occupancy. And the fund has come to term in November 2022. It's supposed to expire, but it has extended for another 2 years. Okay, South Korea, I mentioned, we have divested this asset because of asset rationalization and to refocus on markets that we can grow. Okay, so going ahead, right, events, or rather in 2023, what do we expect? We have actually announced this. First of all, in terms of, we have won a tender from JTC to build a dormitory of at least for 30 years through a JV, which Centurion own 51%, is actually in the east. If you just see our chart, most of our assets are in the north and the west. This is the first asset that we have in the east. It's highly sought after, and we won that. We have also won a management contract to operate 5 CRF facilities in Singapore. We have also able to increase some bed count in by putting in more beds into the QBD, because the QBD has a bigger space, 6 square meter, but the new standards is 4.2. So we managed to be able to increase 888 beds in Singapore. That will add into our revenue. In Tampoi, we have also, because of all the asset enhancement, we are able to increase 290 beds. And also in Westside Malaysia, we secured a 10-year management contract for Westside Cemerlang for 2,200 beds. That will also enhance in terms of our revenue, top line and also bottom line. So for PBSA, we have mentioned we actually divest South Korea, right, in April, which we announced. Plus also the fact that we are actually doing AEIs in all our student assets in UK and also Australia to enhance occupancy and rental income. Okay, looking ahead, what basically we expect the company to perform. Number one, the global economy has continued to recover, as we all know. In fact, it has recovered quite strongly, so demand continues to be strong. We expect our turnover to improve because of that. However, there are some headwinds. We know that globally there's some inflation pressures, and also when interest rates has actually add to the burden because we do have a debt, being a real estate company. But we expect these two costs to be offset by positive rental reversions that we have put in place for us to achieve. With that twin headwinds, we are also trying to focus in terms of management efficiencies, optimize revenue, and also prudent cash conservation. Now, in the medium term, right, to long term, what we are doing, we are trying to grow our business organically. How do we do that? We are trying to enhance our assets. We are enhancing our assets not only to refurbish them, but also increase the bed count when necessary, or where possible. Sorry, not when necessary, right? And over the long term, right? We has announced this as well. Our strategy is actually to continue having a review of our portfolio to unlock shareholders' value. We would like to recycle the capital, right? And that's how we grow. We don't really need to own the asset 100%. We go through JVs, master leases to grow the portfolio management fees to deliver a sustainable and also long-term value to shareholders. So that would be the end of my presentation, right? And I thank you.
Thank you, Mr. Kong. Mr. Kong, Chi Min is here to answer your questions along with the Chief Financial Officer, Ms. Fu Ai Hui, and the CIO, I'm guessing that means Chief Investment Officer, not Chief Information Officer, Mr. Ho Lip Chin. Please give them a big hand. Thank you. So now is the time to field your questions. Looking at Jeff Howie's clock, we have 7:51. I say we're probably going to bust a little bit past that because there are obviously quite a number of interesting questions that you have pre-submitted and we're still eager to hear. You asked the question rhetorically, Mr. Kong, at the beginning about, so why is it that we're trading at a price to book of 0.48? I mean, that's very low indeed. Can you just crystallize for us the answer? Why is it that your stock is so cheap?
Okay, frankly, I also don't know why. I would only say that based upon what I see, maybe the investors or maybe our engagement with investors are not frequent enough. Therefore, maybe you don't understand the business. That's probably one of them. I think some of them also mentioned that maybe it's the gearing that we have, but I would answer this. The gearing that we have is our gearing now is about 43%, right? It's quite similar to REITs, right, or below the 50%. So I don't think that is the issue. But of course, workers' accommodation, some may say that, well, because the government has actually said that during the COVID, they wanted to do some de-densification, right, to the dorms. They have not actually announced that. But I would say that I can say that because of the shortage in beds and all that, and also that the measures that they want to come out or the interim specifications they want to come out is unlikely that will have a great impact to Centurion. So it could be a perception, but
I guess that's why we're here. Okay, so there are two main topics that seem to arise. One, as you've mentioned, is the debt, and the other one is the dividend. A number of you have submitted questions about the dividend. You're asking when will the dividend rise now that the COVID is over, and we saw from your chart, right? Profit is up, up, and up. Quite a number of you want to know when the dividend will increase. So let's put your CFO in the hot seat, shall we? Can you share with us a little bit more about the dividend policy, and, well, I know you have to take it to the AGM, shareholders have to approve it, the whole disclaimer, but what's the outlook on the dividend at least?
actually this one, I think the CEO need to answer. Rather than CFO.
Okay, you don't have to fight. You can both take your turn. CEO first and then CFO.
Okay. Actually, we wanted to give more dividends, that's for sure. Okay. In pre-COVID times, we are giving 2 cents, right? Pre-COVID, right? We are striving to go back to 2 cents. That's the reason why we actually being very conservative. We pay 1 cent in 2022. We struggled with that actually last year in do that because the interest rates has actually gone really, really sky high, right? The interest rates has actually jumped 3 times, if not 3 times, right? 3 times increase. So there is a real pressure to the group in terms of this finance cost. And our strategy has always been, every year on year, we are reducing our debt. As you can see that we pay principal. It's unlike the what's that called, REITs, whereby they take a shorter debt tenure and then they pay only interest only, right? Obviously for REITs, they have no choice because they need to distribute 90% of their profits. But for us, we are a growing company. The exercise or the portfolio that we have is relatively too small. We are unable to actually exercise other measures, or rather, I would say strategy, in order to unlock shareholders' value, like, for example, going for REIT or so. So with the interest going high like that, we have actually make a decision in terms of like, okay, we have to balance between what was shareholders giving back to shareholders. Obviously, my controlling shareholder will want dividend as well, right? Clearly. But because of this heightened interest rate risk, we have chosen to use our money to pay that. So it's a balance. But we would like to assure the investors or even shareholders that We know that dividends is one part of it. If you are paying 2 cents, divide by the share price, for example, is 40 cents, is about 5%, right? We obviously would like to pay even more, but we have to balance also the opportunities in a growing market like this for us I would say growing on the path, or rather the demand that is available to us, right?
And CFO, how difficult a time has it been actually to work that out, given where interest rates, and Jeff Howard, you were saying this earlier too, right? Interest rates are up so much. How's that been?
Because for every 0.25% of the increase in interest rate, it will bring our bottom line by 1 million. So that in view of the heightened interest rate risk, we have to conserve as much cash as we can, but we have to balance. We have, in our AGM, we have assured the shareholders that we will look into these aspects diligently.
Okay. And on the debt front, could you again just take us into the finance department just for a minute? I mean, are you sleeping easy at night with the amount of debt? Are you in any way concerned, as perhaps some in the market are?
Our level of debt is now at only about 43%, as what my CEO said, that is about almost equivalent to the rate levels. So we are pretty comfortable with our existing debt levels. Yeah, but it's just that we need to be wary of the current interest rate environment.
So price to book ratio of less than 0.5. In other words, for every 50 cents that you pay, you get $1 worth of value. And arguably, because it's bricks and mortar, it's not intangible assets, right? And that's, I guess, where Lip Chin comes in as Chief Investment Officer. Can you tell us a little bit more about where you're seeing the asset growth, perhaps? And also, I guess, the quality of the assets. Is there anything that you can say to reassure us there?
Sure. I guess, I mean, we're always on the lookout for growth opportunities and acquisitions. We've been actually pretty, I guess, cautious in terms of how we grow and selectively growing. There are obviously opportunities out there, and we're always on the lookout, whether it's in the workers' accommodation space or the student accommodation space. Under the current environment, again, this whole interest rate, highlight that we've got to be very cautious because, again, unfortunately, I think in real estate terms, as you know, cap rate is a key word. Cap rate has not actually grown as compared to interest rates. So there are things out there that we have been looking at. Buyers are still holding on and asking for a price. And because we're in very resilient asset class, we're not seeing distressed assets coming onto the market. So I mean, obviously, as in investment, we want to grow. But acquisition is not the only way to grow, which is why we're obviously looking out for opportunities where, it could be an asset-light strategy, which I think Shimei has mentioned quite a few times, through leases, through JV partners, and also tenders, which we've been very actively participating, especially in the Singapore market. And that has actually helped to see the profit grow strongly in 2022.
I imagine, unlike hotels, which are and other assets along those lines, they're very much impacted by seasonal factors, presumably. Also, the weather plays a role, whether people travel. Whereas the students have to study, no matter whether it's sunny or rainy, the workers still have to be there in order to take part in these long-term construction projects. Is that a fair assessment from a layman's perspective?
Absolutely. I think, even the headline right now is that commercial real estate have been under tremendous pressure. Work from home, phenomenal, office space being vacated. Retail have been obviously disrupted by online shopping. I think we're very thankful that we're in an asset class that has been very strong, and highly resilient for the factors that you mentioned.
Now, Mr. Kong, tell us a little bit more, again, in answer to some of our questions from you here this evening, about the beds that's up for renewals, firstly, in the second, third, and fourth quarter. And is there actually some risk involved when this renewal happens? Is that something that shareholders need to look out for?
Risk, you mean? Okay. Clearly, there's no risk. There's only upside, no risk. Okay, why? We sign our contracts on a yearly basis. We don't actually commit a long lease like some commercial properties are 5 years, 3 years, right? So we are able to increase the rents upon renewal. So clearly for workers' accommodation, right? Because as I mentioned that, or the ministers mentioned that basically bed rents has actually increased. Upon the renewal, we are able to increase that kind of rents. So it has actually contributed, I would say, that fairly positive to the group's profits or turnover. And that has also able, hopefully, right, because we don't know how high the interest rates will go. At the moment, we can see that Fed has not said that they will stop. They may want to increase further interest rates. So hopefully this good positive increase in rents would actually be able to cushion the high interest rates that currently we're experiencing.
I see. So you renew annually, not every 5 years. Therefore, you're able to factor in a higher rent rather than waiting for a few years before you can raise it. Is there the similar risk then on the downside that, perhaps the contract renewals next year will be lesser?
It'll always cut both ends, right? But what we can see is that for year-on-year basis, because it's a special asset class, and the demand and supply dynamics is what I think I present to you, the reduction is less likely compared to the increase, right? And the shortage is unlikely to abate because of the development needs time. So new developments, I might say, in order to increase the supply, the shortage is going to stay, I believe, 2 to 3 years.
Well, if you've got 2 million people in Malaysia looking, and you've only got, what was it, one in 3 actually gets a bed. Did I read that correctly in your slides?
Yeah, I guess
Huge
so.
waiting lists by the sound of it.
No, that is for Singapore. Singapore, the waiting list was very long, right? For each and every asset, we are looking at 1,000 beds, that kind of range. There's a queuing there, and all these thousands are really different customers, right? Because we lease to SMEs, not to the migrant workers, but to companies. So there's a long list of queue. Right. In Malaysia, there's also I won't say there's a shortage. Shortage in the sense that there are queues and all that in Malaysia, because Malaysia is unlike Singapore. They don't have this law to say that, well, these workers must stay in purpose-built accommodation. So we actually compete with the private residential sector.
Okay. One of your questions is about the average bed rates for the first quarter for Singapore worker dormitories. What is that average, and where do you fall in with that?
Okay, it is $420, as mentioned by our minister.
Per night?
Per month.
We hope.
It's $420 per migrant worker, per month. As mentioned by our Minister Tan See Leng in the recent news, we can say that we are very close to this figure for our renewals and for the new tenancies.
Right. And another one of your questions is, what's the trend for the next 1 to 2 years? Is it predictable in that sense?
We would say that the supply is short for the next 1 to 2 years. We have the view that these rental rates will stay high, relatively high, as the bed crunch is not expected to abate in the near future.
Okay, maybe I add to this. Actually, our rents rates of 420, which the minister mentioned, right, is not the highest. Okay, they say average, right? So the highest we can see the market is 500 and 600. Okay, they have calling rates at 600, right? So we are, of course, at this moment, because it's relatively short, whatever rates we call, they have no choice but to take. That means the customers have to take. But we have taken a consideration, no, this is not the long-term strategy, right? Because basically goodwill to the customers and all that, we are now following the market, that's all. In the past, we are, I would say, a bit price leader, because basically we price higher than the competitors. But at the moment now, because bed rates has actually gone up so high, we are not pricing above or certain price leaders in the market. We are only trading behind. So at the moment, I could see that, well, rates are, if you look at the upper tier, actually our rates can go up even higher, but we are choose not to. So the question just now you mentioned that would actually rates fall, right? Those higher ones likely, I think they will fall, right? When the demand stabilize a bit, right? But I don't expect that our rates will fall.
Tell us a bit more about that strategy, because there would be far more unscrupulous players who would say, great, what a feast. Let's increase our rates to, what did you say, 500 to 600? That's like almost a 50% increase over the average. But you've not decided to go that. What would be the worst thing that would happen if you did act so opportunistically? Like, would your customers leave?
They can't, because they must stay somewhere and they can't find any beds, but they'll be very angry with us, right? They'll say, okay, well, I would tolerate you for during this time around. When the market turns, or even the market, whatever, they will not basically support us anymore. So in terms of customer relationship, and also ethically, we shouldn't do that. I think we only should increase to a certain, because there is a reason why the bed rates has increased. It's also because of cost has actually driven up. There's a cost driver behind. It's not so much as in demand and supply. So we think that we should be reasonable in terms of increasing rates rather than call our rates and either you take it or you leave it, that kind of thing.
And then as soon as they have an alternative, they jump ship.
Yeah,
I guess that's the point. And to what extent does Nest Singapore, tell us a bit more about Nest Singapore. Is that in fact one such possibility that will prove to be a competitor for you?
Well, I guess the reason why the government set up Nest, the primary reason is that they want to ensure that workers' accommodation standard is increased, right? I don't think, we don't believe the intent is to compete with the private operators, but rather to set a benchmark whereby I think private operators should meet that kind of standard. So what we're seeing right now is roughly about 10,000 beds that are being built by Nest, and it will be operated by operators, and there's a tender out there seeking the operators. In that sense, I think if you think what the government is trying to do, there are two things. One is obviously, up the standard, which had become an issue since the pandemic. And secondly, is to regulate demand supply. Okay. So we don't believe that, it's the intent to compete with private operators, but rather to collaborate with people like us to how to up the standards overall and make it better living. And I guess as an international, brand name as Singapore is to be a leader in this aspect of, leading migrant worker accommodation standards globally.
Will you be tendering?
Would definitely be in there competing.
Just a couple more questions, and again, I'm conscious of your time, and we're already running over. Just a couple more, and that is, firstly, in relation to the I guess the prospects as we go from here. So you're out of South Korea. Dong Dae-moon sounds more like a Pokemon character. But are there any new markets? Anything that you haven't yet disclosed to the market that you can reveal just between us here and the YouTube video viewers? Anything that you can tell us about?
Well, I guess the wars are pretty porous. I think obviously the war is big. I mean, we've been specializing in these two asset classes, but we've always said from day one when we started this business that we're not in the dormitory business, we're not in the student hostel business, we're in the accommodation business. And when you define the business as accommodation, suddenly everything sort of become much broader, bigger, and the world is a big playground. I mean, hotel, service apartment, co-living, senior living. I mean, all aspects of it are under, accommodation. But having said that, I think we've also decided to focus in the areas that we're good in, which has been, workers and students. But nonetheless, I mean, it's a big market. I mean, senior living is, I think, something that's been talked about quite a fair bit. And very candidly, okay, not within this forward, we did look at that too, right? Senior living, independent, retirement living type. So there are a lot of aspects, and even the war. I mean, Middle East has been talked a lot about in terms of migrant workers. Is the biggest in the world in terms of that market. But having said that, I mean, we did explore. and ethically we look at it and said,
Maybe I should add to this. Our plates are quite full. Our plates are really quite full. Based on the markets that we are in, right, there are really quite a lot of opportunities, and we are already quite selective. I think the investment department, you have to add many headcounts in order to even expand to look at other aspects.
But I guess that's his job, right? That's why you've hired him. You've hired him to look at these various opportunities. Okay, so please don't tell us any market-moving news tonight. But fair to say that, and by the way, just as a wrap-up question, I introduced you as having been at the company for 27 years. Well, your CFO has also been with you for 23, and your CIO is a relative newcomer at 13 years in the business. What is it actually that keeps you in this company for so long?
Okay, I think the number one, culture. Okay, it has a very good and open culture in the company. I mean, I joined them in 1996. Actually, the chairman is actually is a Chinese, right? Not say Chinese, sorry, he's a Singaporean Chinese. It's technically like most East Coast is like family business, right? But they don't operate like a family business, right? So I've learned a lot of things from him since then. And when he retires, and well, I become the successor. But more importantly is the environment and the culture. And now being a CEO, I would be able to chart, or rather to continue the legacy in terms of having a good company culture within the organization. So I enjoyed it. So that's why I stayed so long.
We've enjoyed your commentary this evening. Please join me in thanking our panelists from Centurion Corporation Limited.
Thank you.
And we're now going to retire back outside for some more informal conversation. Thank you again for joining us this evening, and have a safe drive home. Good night.